Hello, welcome to Capital Sensei. Today, we're going to dive deep into the foundations of modern investing. We'll be exploring the 5 most important rules a young Warren Buffett learned from the legendary book, The Intelligent Investor, written by his mentor, Benjamin Graham. We'll break down concepts like Mr. Market, the all-important margin of safety, and why you should think like a business owner, not a gambler. Whenever we can, we answer questions in the comments. This channel is a space for learning, so if you have any questions as we go along, or even a personal story about your own investment journey, please share it below. Your experiences and doubts can help everyone else in our community learn and grow together. Let's set the stage for a moment. Imagine it's the early 1950s. A young man from Omaha, Nebraska, picks up a book that will fundamentally change his life and, by extension, the entire world of finance. That man was Warren Buffett, and the book was The Intelligent Investor by Benjamin Graham. Graham wasn't just an author. He was a professor at Columbia Business School and a brilliant investor in his own right. Buffett has called this book by far the best book on investing ever written. That's not light praise. So what's the big deal? Well, Graham's book gave Buffett a rock-solid intellectual framework for investing. It wasn't about hot tips or trying to predict the market's next move. It was about discipline, logic, and a set of timeless principles. These principles are the bedrock of what we now call value investing. And today, we're going to unpack the 5 most powerful rules that Buffett took to heart. The very first, and perhaps most famous, lesson is the allegory of Mr. Market. This is one of Graham's most brilliant creations, and it's a mental tool you should use every single day as an investor. Imagine you own a small piece of a private business. You have a partner in this business, and his name is Mr. Market. The thing about Mr. Market is, well, he's got some serious mood swings. He's a bit manic-depressive. Every single day, without fail, Mr. Market comes to your door and tells you what he thinks your share of the business is worth. And here's the key part. He offers to either buy your share from you at that price or sell you his share at the same price. Some days, he shows up euphoric. The business is doing great. The future is incredibly bright. And he's so excited that he offers you a ridiculously high price for your share. He's practically throwing money at you. On other days, he's in the depths of despair. He's pessimistic about everything. He's convinced the business is doomed, that the economy is collapsing. And he offers you a pathetically low price for your share. He's so desperate to get out that he's willing to sell his stake for pennies on the dollar. He's practically giving it away. Now, a foolish person would let Mr. Market's mood dictate their own. When Mr. Market is happy, they get happy and might be tempted to buy more at his inflated prices. When he's sad, they get scared and might panic sell their own shares at his absurdly low prices. They let his emotions control their financial decisions. This is how most people interact with the stock market. They see prices soaring and get greedy, and they see prices plummeting and get fearful. But the intelligent investor, as Graham teaches, does the exact opposite. You have a huge advantage that Mr. Market doesn't. You don't have to listen to him. He's there to serve you, not to guide you. If he shows up one day offering a crazy high price for your shares, and you think it's more than the business is actually worth, you can happily sell to him. You take the profit and thank him for his irrational exuberance. And if he shows up weeping, offering to sell you his shares for a price you know is a total steal, a price far below the company's real underlying value, you can gladly buy from him. You take advantage of his pessimism to increase your ownership in a great business at a fantastic price. And on all the other days, When his price seems about fair or you're just not interested, you simply ignore him. You say, "No thanks, Mr. Market, see you tomorrow," and you go about your day. This simple story completely reframes the stock market. It's not a mysterious force that tells you what your assets are worth. It's a moody, often irrational business partner. The prices it quotes are not gospel. They are offers. Your job is to know the true, long-term value of your business independent of Mr. Market's daily mood. When his price deviates wildly from that value, you have an opportunity. This first rule is all about emotional discipline and turning market volatility from a threat into an opportunity. This leads us directly to the second, and arguably the most critical rule: always insist on a margin of safety. This phrase is the three most important words in value investing. If Mr. Market is the concept that gives you opportunities, the margin of safety is the principle that keeps you safe. It's your financial seatbelt, your parachute, your fire escape. So what is it exactly? In the simplest terms, a margin of safety means buying an asset for significantly less than its underlying value. It's not about buying a stock for 95 cents that you think is worth $1. That's not a margin of safety. That's just cutting it too close. It's about buying that $1 asset for, say, 50 or 60 cents. That huge gap between the price you pay and the value you get is your margin of safety. Think about it like building a bridge. If you know the bridge needs to support a maximum load of 10 tons, you don't build it to hold exactly 10 tons. That would be insane. What if a truck is a little heavier than you thought? What if the materials aren't quite as strong as the lab said? What if there's an unexpected storm? No. An engineer builds that bridge to withstand 15, 20, or even 30 tons. That extra capacity, that buffer against unforeseen problems and errors, is the margin of safety. Investing works the same way. You can do all the research in the world, build the most detailed financial models, and feel certain that a company is worth $100 per share. But the future is inherently uncertain. A new competitor could emerge. A key executive could leave. A new technology could disrupt the entire industry. Your own analysis could simply be wrong. We are all fallible. The margin of safety is your protection against all of that. If you buy that $100 value company for only $50, a lot of things can go wrong and you can still come out okay. If your valuation was off by 30% and the company is only worth $70 a share, you still bought it at $50, so you're still in a good position. The margin of safety makes precise predictions unnecessary. It gives you room for error. This is what separates investing from speculation. A speculator might buy a stock at $100, hoping it goes to $120. An investor, following Graham's advice, buys a stock they believe is worth $100, but they will only buy it when Mr. Market is in one of his depressed moods and offers it to them for $50 or $60. The potential for upside is still there, but more importantly, the protection against downside is built right into the purchase price. Buffett has said that he runs every investment decision through this filter. How much is this business truly worth, and how cheaply can I buy it? The cheaper he can buy it, relative to its intrinsic value, the larger the margin of safety, and the better the investment. It's a simple concept, but it requires incredible patience to wait for those opportunities. It's the ultimate defense against the inevitable uncertainties of the financial world. This brings us to the third core rule, which is the mindset that underpins the first two. Graham taught Buffett to always think of a stock not as a ticker symbol or a blip on a screen, but as a piece of a business. This might sound obvious, but it's a profound mental shift that most market participants never make. When you buy a share of, say, Coca-Cola, you are not just buying a piece of paper. You are becoming a part owner of a global business. You own a fraction of the secret formula, the bottling plants, the distribution trucks, the branding, the marketing campaigns, and the future profits that business will generate. When you truly internalize this, your entire approach changes. You stop asking, what will the stock price do tomorrow? And you start asking, how is the underlying business performing? Imagine you were going to buy a local pizza place in your town. What would you do? You wouldn't just look at the price the owner is asking and say yes or no. You'd do your homework. You'd want to see the books. How much revenue does it generate? What are the costs of ingredients, rent, and labor? Is it profitable? How much debt does it have? Who are the competitors? Is there a new pizza chain opening up across the street? Is the management team any good? You would become an expert on that specific pizza business before you ever put a single dollar down. Yet every day, millions of people buy and sell stocks, pieces of massive, complex global businesses, with less research than they put into buying a new television. They see a stock going up and they jump on board, or they hear a negative news story and they jump off. They're treating stocks like lottery tickets. Graham and Buffett argue that you should apply the exact same diligence to buying a $100 share of a public company as you would to buying a $100,000 local business. This business owner mindset is the antidote to the speculation and short-term thinking that dominates Wall Street. It forces you to focus on the long-term economic reality of the company, not the short-term whims of the market. When you think like a business owner, the concept of Mr. Market becomes intuitive. If you own a profitable pizza place and some crazy guy comes to your door every day offering to buy it for half of what you know it's worth, you'd just laugh at him. You wouldn't panic and sell. Likewise, the margin of safety becomes common sense. You would only buy that pizza place if you felt you were getting it at a bargain price that protected you in case business slowed down for a few months. This mindset is about grounding your investment decisions in business reality. The stock price will eventually, over the long run, follow the performance of the underlying business. So your job is to find good businesses run by competent and honest managers, and then to buy into those businesses when Mr. Market gives you a price that provides a substantial margin of safety. It's that simple and that difficult. The fourth rule is a lesson in intellectual humility. Operate within your circle of competence. This is one of Buffett's most famous adaptations of Graham's principles. It's the idea that you don't have to be an expert on every company or every industry to be a successful investor. In fact, trying to be an expert on everything is a surefire way to fail. Instead, you need to define the boundaries of what you truly understand, and then stay strictly within those boundaries. Buffett uses a great analogy from baseball. To be a Hall of Fame hitter, you don't have to swing at every pitch. The pitcher can throw the ball high, low, inside, or outside. The batter can just stand there and wait. The game only punishes you for striking out on pitches that are in the strike zone. The key to success is waiting for a pitch right in your sweet spot and then swinging for the fences. In investing, there are no called strikes. You can wait forever for the perfect opportunity. Your circle of competence is your sweet spot. It's the collection of industries and businesses that you can genuinely understand. Maybe you've worked in the retail industry for 20 years. You understand inventory, supply chains, branding, and consumer behavior. That's your circle. You're probably well equipped to analyze a company like Walmart or Costco, but you might know next to nothing about biotechnology or semiconductor manufacturing. Those are outside your circle. The intelligent investor doesn't feel the need to have an opinion on every hot stock. For decades, Warren Buffett famously avoided technology stocks. During the dot-com bubble of the late 1990s, he was widely criticized for being a dinosaur, for not getting the new economy. People laughed as tech stocks soared and his company, Berkshire Hathaway, underperformed. But he simply said he didn't understand their business models or how to value them. They were outside his circle of competence. And what happened? The bubble burst. Companies that were supposedly changing the world went bankrupt overnight. Investors lost trillions of dollars. And Buffett, by simply sticking to what he knew, businesses like insurance, consumer goods, and banking, preserved his capital and was ready to pounce on new opportunities when the dust settled. He didn't need to predict the crash. He just needed to be honest about what he didn't know. The size of your circle is not important. What's critically important is knowing the perimeter. It's about having the self-awareness to say, I don't understand that, so I'm not going to invest in it. This protects you from following fads, from buying into hype, and from making bets on things you can't possibly analyze with any degree of confidence. It's a powerful discipline that forces you to invest based on knowledge and analysis, rather than on emotion or speculation. So, figure out what you know and stick to it. This leads us to the fifth and final rule, which is more of a strategic choice based on your own personality and circumstances. Graham divides intelligent investors into two categories: the defensive investor and the enterprising investor. Understanding which one you are is fundamental to building a strategy that you can actually stick with for the long term. Let's start with the defensive investor. Graham describes this person as someone whose primary goal is safety of principle and freedom from effort, bother, and the need for frequent decision-making. This is not a stupid investor. This is a smart investor who recognizes they don't have the time, the interest, or the temperament to do deep, time-consuming research into individual companies. They want a simple, robust, and low-maintenance approach. For the defensive investor, Graham recommended a straightforward strategy. First, maintain a simple portfolio, perhaps split 50-50 between high-grade bonds and a diversified portfolio of leading stocks. Second, when buying those stocks, only buy shares in large, prominent, and conservatively financed corporations. Think of the dominant players in stable industries. Third, insist that these companies have a long history of continuous dividend payments. And fourth, and crucially, put a strict limit on the price you are willing to pay for them, perhaps based on a simple metric like a multiple of their average earnings over the past several years. The goal here is not to beat the market or find hidden gems. The goal is to avoid serious mistakes, participate in the long-term growth of the economy, and sleep well at night. It's a strategy built on automation and simple, proven rules. For the vast majority of people, this is almost certainly the right path. It acknowledges the realities of a busy life and the difficulty of outperforming the professionals. Then you have the enterprising investor. This is also called the active or aggressive investor. This person is willing and able to devote significant time and effort to the study of securities. They have the intellectual horsepower, the emotional temperament, and most importantly, the time to look for opportunities that are off the beaten path. Their goal is to achieve a better-than-average return, but they know this requires a better-than-average effort. What does an enterprising investor do? They might analyze smaller companies that are ignored by Wall Street. They might look for special situations, like companies going through mergers, spin-offs, or reorganizations. Or they might engage in what Graham famously called cigar butt investing, finding a deeply unloved, ugly-looking company that is trading for so little that it has one last puff of value left in it. Buffett did a lot of this in his early career. The key danger here is self-delusion. Many people think they are enterprising investors, when in reality, they are just speculators. They take big risks without doing the necessary work. Graham's warning is stark. If you are not going to make the full commitment of time and effort required for the enterprising approach, you should resign yourself to the much better and safer results of the defensive approach. There is no middle ground. A half-hearted enterprising approach is the surest route to disaster. This final rule is a call for self-assessment. Be honest with yourself. Do you have the passion and the hours to dedicate to becoming a serious student of business and finance? If so, the enterprising path might be for you. But if you have a demanding job, a family, and other hobbies, and you just want your money to grow safely over time, then embracing the role of the defensive investor is the most intelligent decision you can make. So, let's tie these 5 rules together. They form a complete, coherent philosophy. You start with the right mindset. You are a business owner, not a speculator. You then use your circle of competence to identify the businesses you are capable of understanding. From within that circle, you wait for the manic-depressive Mr. Market to offer you a price that gives you a massive margin of safety. Finally, you choose a broad strategy, defensive or enterprising, that matches your own personality and commitment level. This framework is powerful because it's not about predicting the future. It's about preparing for it. It's not about being the smartest person in the room. It's about being the most disciplined and the most rational. It protects you from others, but most importantly, it protects you from yourself, from your own emotions of greed and fear, which are the investor's greatest enemies. The lessons from the intelligent investor are as relevant today as they were when Buffett first read them over 70 years ago. Technology changes, markets change, and economies change. But human nature does not. People will always be prone to cycles of euphoria and despair. And as long as that's true, the principles of treating the market as your servant, demanding a margin of safety, thinking like a business owner, staying in your circle, and knowing your own limitations will remain the unshakable foundation of intelligent investing. They are the tools to turn the chaos of the market into a source of rational opportunity.